Hey everybody, today is December 9th, 2021. I wanted to do a quick video in response to some questions that came in this week regarding the pullback we said that started around Thanksgiving and has really kicked off a pretty heavy bout of volatility. So let's jump right in and take a look. So this is a familiar chart for many of you, which is the D-short chart measuring the pullbacks off of the previous high. So anywhere you see a yellow highlighted number is a meaningful correction off of a previous high. And as you can see right now, we're sitting about 3.53% as of December 3rd. Today, the market was finished considerably higher than that as it sort of creeped its way back up into new high territory, although I do not believe we eclipse that mark today. But this just is to give us perspective as far as where we've been. You could always argue that we're due. We did get a little 5%, just a little kiss right there around Thanksgiving. But so far, this chart is not sounding any alarms, that is for sure. So where we were at our last video, July 28th, we see that we were sort of preparing for the same type of thing where we're looking and saying, hey, what's a 5 or 10% pullback look like from here? The market may be a little frothy. Some of the volatility, admittedly, wasn't as high then as it is today, but this is sort of what we were looking at. And when we compare it to where we are today, this is that same benchmark, if you will, or that same area that we were looking in July. At that 5% correction, and here we see we have pulled back about that with that 3.53% range. There's the 5% sort of demarcation line, if you will, and then a 10% one next to it, and that still keeps us in a really healthy range of support, even if we do get further pullback from here. But it's important that we remember sort of the context of seasonality and where we are in relation to today's market. And of course, we're in December. And December brings its own sort of characteristic with it. Historically, when we're looking at equity returns, here we're going to look specifically at the S&P 500 and the Russell 2000 index. And for the S&P, we're going back to November 30 of 1950. And in the Russell, we're going back to November 30 of 1979. So we've got some history here. And the majority of the time, in fact, over 3/4 of the time, these months are positive over this period, but it comes sort of in a particular wave or a particular push. So the first half of December is not typically very stellar. About break even on the S&P and down for the Russell 2000. But then in the second half of the month, it picks up. S&P up about 1.5 and Russell up over 2.5 points, to where you get an average of around 1.5 for the S&P and 2.25 for the Russell 2000. So historically, again, we're in a seasonally strong period, whether we want to chalk this up to the Santa rally or however you want to refer to it. Historically would suggest that we have it wouldn't be unreasonable to see or to expect or to experience positive equity returns in December. So again, I want to take a look at rankings. Back from our last video in July, there was some concern about the U.S. core equity being ranked in first position, 100%, the highest possible ranking against all other asset classes. And was that sort of a indication that, the end is nigh? Was there a problem here? Cash was at 2.1%. And where we are today is U.S. core equities at 98.59 and cash is at 7%. So not a whole lot of change has taken place. If you had taken a nap from July to today, you would have missed out on all the volatility, all the great sound bites in the news. But the equities have moved higher, and as far as the ranking goes, not much has changed. But it's important that we keep in mind that even though the big picture ranking is almost identical, underneath the hood, things could be a little bit different. And it's very similar to the relationship between the face of a watch and the gears of the watch. Those gears are working really, really hard, and that face of the watch doesn't change a whole lot. Okay, so what we want to do is we want to look at some ratios with regard to what's happening below the surface in the S&P that could give us cause for concern or give us confidence moving forward. Okay. So the first ratio we want to look at is the discretionary versus staples ratio, or this is the wants versus needs ratio, as you could refer to it. So this is these two indices are plotted in that classic arm wrestling match here with regard to rising prices are being attributed to the discretionary or the wants side of the ledger, and falling prices, represented in the falling O's, represent the staples side of the ledger or the needs side. So markets tend to be more bullish when discretionary areas are leading. And as you can see here, we have had two persistent periods, well, one of them persistent, one of them more of a blip, where the staples were in command, the staples were in charge, and that was during the Great Recession, and then the piece we've had, just recently gone through with COVID. But as for today, and for most of the time since the end of 2000 or the early 2009, March 9th of 2009, discretionary has been in control. There are occasional pullbacks. There's definitely some column of O's in here, and then of course we have what happened at COVID. But big picture here is that the wants side of the ledger is outperforming the needs side of the ledger, which is bullish for today's market. Now, I want to look at growth versus value. This is a relationship that is really important as far as asset allocation positioning and whether we want to own value-oriented stocks or growth-oriented stocks. And we want to let the data tell us that. There's some wonderful books and some wonderful theories and ideas on value investing. But what we won't want to do is own a stock that's a value and have it stay a value for 20 years. We want that thing to grow. We want to make money with it. So it's important that we understand the relationship between growth and value. And again, from 2002 to 2008, there was a period where value was in control. But since then, growth has been in the strongest position. And, again, earlier this year, bit of a pullback. Some of the inflation scare pushed some of the value stocks on the table, but it's kind of reversed back into a buy for the growth side. I'd like to see one more tick up here to confirm it, get another consecutive buy. We don't have that yet, but still, the current situation would favor growth over value. Last ratio here is the relationship between transports and utilities. So this would be measuring what's the flow of goods across the country versus sort of money following the safe, stable utility route. Okay. Now this relationship is a little bit more choppy, probably due to the volatility in transports more than anything to do with the volatility in utilities, but it is still pointing up and to the right. So transports winning again. I'd love to see another X pop up here just to get another be a third consecutive buy signal for transports over utilities, and that would just give us more confirmation, which would be great to see right now. But the current state is positive for equities. Lastly, I want to talk a little bit about cash rankings and money market, and the VIX. So when we're looking at where we would begin to see stress, more confirmation. You can't trade an entire portfolio on just one signal. So you need to look for confirmation in different areas of the marketplace to echo the same themes before you can make large convicting or high conviction positions across entire portfolios. So this relationship here between money market percentile rank, which is where we get those rankings earlier, the 2.x and the 7% cash ranking, that comes from this chart. And then looking at the VIX. Now this again looks like the heart pattern of a small mammal here, but this is the VIX. This is the fear index, and it's representing it's sort of a mathematical representation of fear in the market. When we overlay the two, we can see that there are periods of time where the VIX is elevated, but money market percentile doesn't really confirm it. There's not a persistent enough or a long-term enough event to really confirm the volatility with the VIX. And there are times where it does. It works very well sometimes in these periods highlighted in red. And today we're in a situation where we're really not confirming this move in the VIX with anything with any of the money market percentile rank movements. Now it has moved up from 2 to 7, but I'd want to see this move up maybe to 2025 before there would be some concern. I'm not hoping that happens, and it could happen very, very quickly. So we have to be vigilant, and we have to be careful, and we have to be on our P's and Q's, if you will, just to make sure that we don't miss anything in that regard. So I hope these slides and this information can help remove some of the stress and some of the anxiety. I don't want you carrying that into the holiday season. If you do have specific questions or something that is keeping you up at night, feel free to reach out. Until then, Merry Christmas, Happy Hanukkah. If I don't talk to you before the new year, have a great new year, and we'll chat soon. Thanks.